For the next 5 days, the EDGEFINDER is free to try. No, I'm not kidding. It is actually an event that we're doing this week, and we're going to be leaving a link down below in the description. If you'd like to try out the EDGEFINDER during this time, we are offering it free to everyone between now and Friday. So if you have not already applied to get access to the free event, the link down below in the description is going to be your new best friend. So I invite everybody who's watching this video, if you don't already have a copy of the EDGEFINDER, now is your chance to try it for free. And I ask one favor of you. If you would like to take this trial and you apply for it, take it seriously, try out the tool, and all I ask is that if it seems like a tool that would actually be beneficial to you and you really like it, consider purchasing it at the end of the week. Keep an open mind. Yes, it is a paid product, but this free trial is a chance for you to see the value that we know that it offers and want to share with more traders around the world. So let's jump into today's video. The S&P 500 is off to the races again today. You can see a big break to the upside, at least at the time of recording this video. It is still very early in the New York session, but I wanted to show you kind of where I'm at with this trade that I've been in. I just trailed my stop loss this morning on the live stream into profit here just below this market structure low. This week, we have the Jackson Hole Symposium event, which is a big event where basically Fed members get together and they start to kind of strategize or continue to strategize for their upcoming future events and what they plan to do with the Fed funds rate, where they see the economy, where they see the global situation. It's a pretty big event and it happens every year. So this Thursday and Friday, we are expecting some volatility from that. And on Wednesday, we also have the Fed, the meeting minutes as well. So it should be a pretty big Fed week to kick us off here. And I want to talk a little bit about where I'm positioned and what I am expecting for this kind of event. First of all, on the S&P 500, I bought the dip, and that ended up being one of my better plays this year. If I take a look at SPY, you can see I've got my stop loss trailed on this one, and this is the trade that I've been in since, 2 weeks ago, right? I bought the big Monday sell-off as an opportunity. I thought that would be short-lived, and it ended up being the correct call with the market ripping higher here. And, if you're a bear in this S&P 500 rally, the tricky part that I have for you is this. We saw the big dip and everybody got very bearish on YouTube. I saw it all over social media, oh, this is the crash, this is the start to it. The VIX is going to take us all to zero. And then, we proceeded to bottom out, and all key levels, the 38.2, the 50%, and the 61.8, have been taken out pretty decisively by the bulls. We paused at some of these levels, but if we take a look at the price action here, it does seem to me to be very clearly in favor of the bulls, and we do see a continuation of this year's dominant uptrend for stocks. And I've been, bullish this whole year pretty much and looking for opportunities to add. So this recent dip was a really nice buy the dip opportunity. That being said, let me not pat myself on the back too much because I bought a couple times too early on the NASDAQ and the Russell. I was early to trying to buy the pullback as the market was dipping, but this I think it was my fourth attempt to buy the dip, ended up being the best possible entry I could have asked for. And we ripped into, pretty much a straight line here for the last 2 weeks. That being said, are we going to make a straight line through the all-time highs? That is the question that a lot of people are wondering. Does this have legs to make new highs? And I'll say this now. I think the answer is yes. I am bullish on this thing. I think we could see a straight line move through the highs. However, that is not usually what happens. Usually markets do not move in straight lines forever. They usually move in flows, even when they are uptrending or downtrending. So I would not be surprised if with such a volatile potential list of items this week with all the Fed stuff, that we do see some volatility here and perhaps we put in some sort of higher low, in which case I would actually use that as an opportunity to continue to trail my stop loss further into profit inside of our VIP signals group. By the way, I do share all of my trades in the form of signals for members inside of our Discord. The link to that can be found down below in the description. And just a heads up, this is what it looks like. So anytime I take a trade or update a position that I'm in, all of them get sent to our members inside of the Discord. So you can find that information down below in the description if you'd like to sign up for that service. So what if we pull back? Well, here's my thought. If we do pull back and we see some sort of support being held before, my stop loss gets hit, then I'm very confident to continue holding this position. The only scenario in which case I actually close out is if my stop loss gets hit on my SPY position, in which case I would go ahead and lock in profits from my trade back a couple Mondays ago. Though, again, I really think that the path of least resistance this week is for the Fed to signal rate cuts are coming, that the economy's in a decent place, and that we continue to chug along towards a soft landing, which all sound very bullish to me. And, not only that, we do have, not this week, but next week, we have NVIDIA earnings. I'm an NVIDIA shareholder proudly now. I've gotten a chance to buy the dip recently. I bought some NVIDIA. I also bought some other stocks inside of my portfolio here. I'll show you this. So just move my camera for a second. I'm long NVIDIA, CrowdStrike, Tesla, Airbnb, and Google. So a couple stocks and then some trades that I'm still in, like the Russell trade, the semiconductors trade, and the S&P 500 position. Outside of the stock market side of things, I am still very bullish on gold. However, didn't quite give me the pullback. This thing is so strong, and it's been a rough year for the bears in gold, because I think up to now, I think gold is up 20+% for the year. So this has been a year for the bulls, that's for sure. Being bearish has been a rough ride, and I'm not saying that to pick on anybody, because at the end of the day, sometimes you're right, sometimes you're wrong. But in this case, 2,500 is a huge milestone for gold, very impressive. And the S&P 500 has actually, I believe, underperformed gold this year. That's how bullish gold really is. That being said, I think that is set to continue. I do think that dips are possible buying opportunities on gold for me personally. And I'll express a little bit of that why here in the Edge Finder. So if we take a look at the gold reading, we are getting a bullish overall rating for the gold chart. And I want to show you something that's contributing to this. It's the COT report, and the COT data shows us what institutional money is buying or selling. And we take a look at the proportion of long to short contracts traded by hedge funds and smart money, players in general. We see a very strong tendency towards being long. 84% of contracts traded on the long side as opposed to the short side. We also saw in the latest filing, this past week's filing, a big increase in the number of long contracts owned by institutional money, so buying here, and a small increase in short positions at the same time. Long story short, basically, the big money seems to be favoring the buy side. That keeps me bullish, and again, it also contributes to our overall score here with a +2 assigned to the commitment of traders data column for gold. I'd also like to take a look at the dollar yen, which is getting a very bearish reading on the Edge Finder. Some of the yen crosses are looking really interesting to me right now, so let's go take a look at that. So if I pull up USDJPY, here is the daily chart. What you can see is that we pulled back. I don't know if you guys spotted this. From the highs to the lows, we drew the fibs, and we got the 38.2% retracement level, which tagged beautifully and immediately saw rejection. I would not be surprised if the dollar yen does continue to move lower in the short run, as perhaps we see a coordinated or organized buyback of the Japanese yen carry trade unwind that went on the last few weeks, right? There was a big liquidity crunch or concern about, hedge funds that are borrowing yen or shorting yen, needing to cover their position off of increased risks of a potential global recession. I know that sounded just like a really fancy long list of things, but basically a lot of hedge funds were short the yen and then buying other currencies, buying other stock markets, bonds with the borrowed currency. Because remember, when you borrow a currency, you're basically shorting it. So you borrow currency and then you go buy other things with it. Well, with increased risk of a possible recession, there was a reversal of that trade, causing huge demand for the Japanese yen. I think that in the short run, there may be a little bit more of that to go, but overall, I'm not by any means a big believer or big bull on the yen. Remember, bullish on the yen would imply going down lower, right? Because you're selling dollar, buying yen. But I'm not personally really convinced of that trade. So even though the Edge Finder is giving us a really nice signal here and has been very correct about the yen recently, I'm a little bit cautious to pick up any big positions here. If we get a deeper retracement, I may look to apply some sort of hedge to my risk on tendencies, right? You've seen me very bold up on the stock market right now. So maybe a reasonable hedge could be shorting the dollar against the Japanese yen on a rally here. But I just don't love trying to time this or trying to get really aggressively bullish the Japanese yen at the same time that I'm very strongly convinced that I think we could see higher prices for stocks and bonds, by the way, at the same time. I'm pretty much thinking that for the end of the year, we do see a continued rally of the stock market, move that we've seen this year. And if I'm wrong, of course, I've got stops in place to control my risk. Taking a look at the dollar index, we can see fresh lows here for the day or close to it at the time of recording this video. And this thing does does still just look weak to me. At this point, the dollar is just not holding support levels at all. We tried here, we tried a little bit there, and sellers have just been very strong as increased expectations for rate cuts continue to roll in for the US, right? And I imagine that market participants are a little bit skittish. If you're a bull right now, you might be a little nervous going into the Jackson Hole Symposium, as it is likely that the Fed will signal more rate cuts coming down the pipeline as economic data starts to cool and the jobs data now takes precedence over the inflation data. Let me show you what I mean by that. So the inflation data is a big part of what the Fed pays attention to, but it's not the only thing. Inflation data has made pretty significant progress and has actually continued to cool to where it currently is, which is at 3%. So we've seen a nice overall cooling of inflation. And so what was this big bad threat or this evil dragon monster a couple of years ago has diminished down into like a small monster, right? It's not as big of a big deal. But here's the thing. Now what we see is unemployment rate in the United States on the rise. And this, I think, is now taking the focus for the Federal Reserve. Their new plan or new goal is, okay, we need to cut rates in order to help with the rising unemployment issue. This is not a threatening thing per se. We're not at crisis levels by any means, but we are observing a trend up in unemployment rate. So the Fed is probably, in my view, going to focus on this in their upcoming meeting here this week, which could lead ultimately to signaling of more rate cuts. That signals weakness in the US dollar. It also, to me, signals bullishness in the stock market if the overall economy holds in there. I have been saying this many, many times, but I've gotten a lot of comments of people saying, Nick, when they cut rates, isn't that a super bearish thing for the stock market? Doesn't that mean a recession is coming? And the thing is, I've said this many times, so I don't want to repeat myself too many times here, but the long story short is that rate cuts can be very bullish or very bearish for stocks. It's not about the rate cuts at all. It's about where the economy is at when cuts begin. And right now, the economy is at a pretty stable spot. It's cooling off, which is why inflation is a lot better than where it was. But it's not by any means in a crashing situation. So I think that we're probably going to see rate cuts for the right reasons this year, and that leans me towards the bullish side of stocks and the bearish side of the dollar and bullish side of gold. I basically think that we're going to be able to hold the line here and actually see a soft landing. That is my personal opinion. If I'm wrong about that, am I going to lose everything? No, I will lose money, but I'll control my risk as I always do as a trader. That is the A1, that's A1 trading reason we do that, right? Is to really key in on risk management. By the way, guys, I mentioned at the top of this video, but remember the Edge Finder is free this week only, Monday through Friday. After Friday, it'll be closed to everyone. But if you'd like to try out the Edge Finder between now and then, use the application link in the description down below. Thanks for watching. If you're looking for a better brokerage, then stick around for a second. I'm going to tell you how you can get some free sign-up perks with great brokerages all around the world. Whether you trade FX or indices, commodities, futures, all of the above, I'm going to show you a really cool way that you can get free sign-up perks with your new account. So if you're interested in switching into a different brokerage, you can get things like deposit bonuses or free stock shares, or you can even get access to some of our products for completely free. All you have to do to find out current perks being offered to new depositors is go to a1trading.com/brokers. That's a1trading.com/brokers. And as you look at that page, you'll see all these different offerings that we've currently locked down for you guys as subscribers, as viewers. Now, of course, we get something out of this. If you choose to use these links, you'll be supporting our page. But in return for the viewers, we've got great sign up perks available for you guys so that you get some free game just by signing up for a brokerage if you're looking to do so. So check it out on our website. You can find current deals at a1trading.com/brokers. Thanks for watching this video, and on the screen right now you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.